From our world headquarters in New York, Bloomberg Surveillance futures up 4, up a little bit from Ken Pruitt's Bloomberg First Word with us to kick off our marathon here. We're going 5. This is like work, Neal.
It is indeed.
This is work. Neal Soss with us from Credit Suisse. We want to go beneath the headlines. We got payrolls, great. We got unemployment rate. You've got a nice little thing here on temporary jobs. First of all, what's a temporary job?
The sort of thing that sometimes you see filling in an office when somebody takes maternity leave or is
it 20 hours
and so forth.
Is there like a definition?
Yeah, but the key is that it's provided by services that move these workers from place to place, so that it's permanent headcount from the point of view of the employer, but a temporary assignment from the perspective of the worker.
What are you going to observe at 8:30 today when you look at temporary worker dynamics? What do you want to see?
Oh, it would be lovely to see that have a plus sign in front of it. At the very least, you'd like it not to be declining the way it was. And indeed, that's the pattern we've been seeing.
It's been improving.
It's been improving, and it's a very cyclical sort of indicator. When firms are willing to replace people on a temporary basis, that's a good sign. When they take the view that, well, someone left, but let's take advantage of that as a permanent headcount reduction, that's obviously a poor sign. So temporary workers tend to be very cyclical.
Neal, are you in line with that forecast of 9.5% unemployment for us?
Yes. One of the patterns that we see typically in business cycles is that as you get near the bottom of the recession, the signals get mixed, and you get some reports that are a little better than you might have expected, like the small decline in unemployment reported a month ago. But those don't really hold because the labor market is typically a lagging indicator.
Sure, and those numbers are subject to revision anyway, right?
Yeah, although on the month, it's the payroll rather than the household survey that tends to get revised. And that, too, is a cyclical indicator. Those revisions, when they are in the up direction, are very good news relative to having revisions in the down direction, which is what happens in recessions.
So is 10% pretty much a foregone conclusion, though, as we look ahead?
I think that's our forecast, and I think broadly speaking that is the consensus forecast, that unemployment still is on a rising path for a few more months.
And how high does it go?
Oh, 10%.
10% is going to be the high?
Yeah.
So that makes you fairly optimistic, I mean, compared with your peers, right?
Well, there are some 10.2s, but
we had an 11 the other day.
Yeah, well, that I think would be not within it's not within the consensus, I would say. That's on the high end.
What is the character of this? I had a great conversation with Bruce Kasman last night on this. Is this a structural? When you look at this, are you spending more time on the cyclical give and take, we're coming out of a recession, or are you spending more of your time on structural analysis, permanent change within our labor economy?
Well, the answer clearly is both. And what I find as a matter of communicating is that it's much more difficult to keep that separate now than it used to be.
They're blending.
They're blended.
Thank you.
Because they happen at the same time.
Like, I'm going to put that out on Twitter. That's so important. There's not enough discussion about this, that there was a financial crisis, and some of the cyclical analysis is blending in with the structural analysis.
Exactly. And one of the structural features, among other, and this is a very adverse one, is that the odds of getting re-employed in this downturn are vastly worse than they have been in past experience. That's not a good sign. That's a structural kind of event, we think.
We keep talking about unemployment being a lagging economic indicator. So is it going to tell us that the recession is over now, or is just about to be over, or that's coming later?
Well, I don't think unemployment will tell us that now, but by and large, the labor market indicators broadly are very consistent with the pattern you see when a recession is over. The weekly jobless claims peaked as long ago as March, and the pace of job declines has been smaller with passing months now than it had been before. And in recent months, you've had a few months of upward revisions to the previous estimates. All of those are the sorts of things that tell you that the business cycle as a whole has hit a bottom, and the labor market still has a little ways to go before it reaches its absolute bottom.
Now, we welcome all of you on Bloomberg Television worldwide and on Bloomberg Radio, Sirius and XM across the country and across Canada. With us, Neal Soss, Chief Economist at Credit Suisse, to kick off our marathon 5-hour event. Ken and I will have a few grayer hairs by the time we're done at 12 noon today. When you look at the rest of the economy and you fold in this labor economy, one of the messages Ken and I get all the time is, okay, this is great. All these economists can feel great about improving GDP, but here we are with such a lagging, bad feeling about labor. Does the public just get it wrong? I mean, is it okay to separate the two, or do you wish we blended it more together?
Oh, I don't think the public's getting it wrong at all. I think the distinction is a subtle one, and it's difficult to convey, and it's difficult to keep always in mind. And that's the distinction between doing better, that's the cyclical improvement we're having, and doing well, which is our goal, getting back to levels of full employment and full resource utilization broadly. And by and large, there's not a forecast that gets you back to doing well quickly.
Well, if you take Dominic Constam's interest rate call, sub 3%, if you look at your corporate profit people, are business people going to have the animal spirits to jumpstart the rehiring?
Well, it's not a matter of looking for a rapid recovery. That's one of the features of this episode. People are by and large saying it's a recovery. But if you look at the numbers are mediocre or lackluster. And in fact, that word keeps coming up around forecasts of improvement. So again, it's this distinction between doing better, sequential growth. After all, we had sequential shrinkage and dramatic shrinkage in the GDP and labor markets in almost any metric you care about as recently as 6 months ago. Now we're looking for plus signs in front of some of those characteristics. That's all good. But it's from a hole that's so deep that growing out of that's going to take rather a long time.
Yeah, the shock of that drop of fourth quarter of 2008. We'll come back and talk to Neal Soss about the exhaustion rate. I want to talk to him about this transfer from claims over to federal emergency claims, over to people falling off of those claims numbers, how that folds into what we'll see at 8:30. The first thing you do on the weekend is read The Economist magazine, right?
No, I do that on Friday morning.
You do that on Friday morning. It's on the Kindle, folks, just out The Economist with their treatment. The Vote That Changed Japan for your weekend reading. They've got some work there on technology as well. I bring this up because I was talking with Neal Soss here of Credit Suisse about the Journal this morning, and you mentioned that article on state government in the Wall Street Journal. I mean, you know, the shutdowns and the budgets. Where are our state and local governments going to be in 12 months?
Well, just for starters, 1 out of 7 people on a payroll in the U.S. works for the state and local government sector. About half of them are your local public school teachers. So the shock to state and local finances that we've been experiencing is relevant to the employment figures we're going to be seeing in just a little while. Now, furloughs don't count in that regard. That's a technical sort of thing. But the loss of incomes to state and local workers and so forth is a real relevant part of the way people think about consumption and why it's going to be a sluggish recovery and so forth and so on. Now, the state and local sector gets its revenues from sales taxes, which are hard to get with low inflation and weak retail sales, property taxes, and property's become a bad word, obviously, in the last couple of years, and in some cases from income taxes, and incomes, of course, have been rather restrained. So the revenue side of those budgets has really been hammered.
By the way,
something's got to be done about that, of course.
Is there any evidence to show that the decline in property values has resulted in lower property taxes?
Not that I'm aware of. In fact, if my local community is anything to go by, it looks like the opposite.
Yeah, it pretty much never does.
Well, not only that, but you have some real issues associated with pension and so forth. You know, the pension obligations of this local school district, for example, are still there, but the markets haven't been kind, and the property tax base is not kind. And you have to pay the pension obligation anyway, so you have to raise the taxes in order to get the cash, which is not a convenient thing to have happen, and we need a bailout.
Where are you on the new normal? This big debate raging. Bill Gross publishing this week, really re-emphasizing what we've heard from Dr. El-Arian. Do we get back to an appropriate potential GDP, or is there something new here that will be a bit more subdued?
I think the combination of various activities in the economy is going to be decidedly different. That's the new normal. Consumption won't be driving the economy the way it was. But in terms of the overall growth of the economy, it's not clear to me why export and infrastructure investment and a variety of other activities can't give you the same growth rate eventually.
Do we need a weak dollar to assume better export activity?
I don't think so. I think we're going to get that. I think it's part of that story. But I think the most essential feature is domestic demand in some major foreign economies, China, India, and a number of other such large economies.
Yeah, but I mean, I remember John Snow early in the Bush administration saying the same thing. Where's that domestic demand been? Other than China, Where is the engine that's going to make that? Is it a stronger Europe?
Well, we're not looking for a structurally stronger Europe, although cyclically we think they're having a rebound too. We think that the future in that respect has to be where the younger populations and the rapid economic development populations are, and that's largely in the emerging markets.
Quickly, or 15 seconds, what's a single thing you're going to look for beneath the headlines at 8:30 today?
The length of the work week.
Length of the work week.
Yeah.
Okay, very good. Neal Soss, Chief Economist, Credit Suisse, thanks for coming in and kicking off our 5 hours of surveillance today. And, of course, at 8:30, we will go rapidly beneath the headlines and give you all the data on the jobs report.